All right, let's get right into it. For years, Mercado Libre, MELI, has been one of those stocks everyone loves. It's the king of e-commerce in Latin America. But just recently, this absolute giant took a massive tumble, and it has kicked off a huge debate. So is the party finally over, or is this the buying opportunity of a lifetime? Let's break it down.
Just look at this chart. After kind of treading water for a bit, the stock didn't just dip, it absolutely plunged. I love how one analyst put it. The market chose violence. This wasn't just a bad day, folks. This was a statement. The sheer force of this drop tore through key support levels and basically started a war between two completely different ways of seeing what just happened.
And that really gets to the heart of it, doesn't it? The central question we're tackling here. On one hand, are we looking at a falling knife, a stock that's breaking down so hard you'd be crazy to try and catch it? Or, on the other hand, is this a golden opportunity? A healthy dip and a long-term winner that's practically screaming by me. To figure that out, we've got to hear both sides of the story.
Okay, let's start with the bears. For them, this is not just some minor pullback. No way. They see this price action as a blaring siren, a clear signal that the good times are over and a major trend reversal is happening right now. They think the smart money is sprinting for the exits.
So a huge part of the bear argument comes down to this idea called Wyckoff distribution. Now, what's fascinating about this is that it's not about random panic selling. It's a theory that the big players, the huge institutional funds, are methodically and quietly selling off their massive positions to everyday retail buyers right before the floor gives out. The bears are arguing that this recent plunge is the final dramatic proof that this has been happening.
And their argument really stands on a few key pillars. First, valuation. They're pointing to a price-to-earnings ratio of around 63, which, to them, looks pretty rich. Second, they're getting nervous about the company's debt, which has jumped 44% in a year. And third, they see growth slowing down from those insane triple-digit rates to something, well, a lot more normal. You mix all that with the ugly technical breakdown we just saw and the economic storm clouds gathering in Latin America, and, well, you've got a pretty potent cocktail for the bears.
This quote from one of the sources just nails the bearish feeling perfectly. That incredible volume on the way down tells them this wasn't just a few people taking profits. This was a decision, a coordinated institutional move to get out. For them, the path of least resistance is now straight down.
But of course, for every seller there's a buyer, and there is a completely different side to the story. So let's flip the script and dive into the bull case. For them, the long-term growth story is as strong as ever, and all this recent chaos, it's just noise. And maybe, just maybe, a fantastic buying opportunity.
The bulls come right back at you with some absolutely staggering numbers. I mean, get a load of this. A nearly 96% compound annual growth rate for their earnings per share over the last 3 years. This isn't some struggling company. This is a business that has been executing at an incredibly high level.
And it's not just paper profits. We're talking about cash. The company's ability to generate cold, hard cash is just off the charts, with free cash flow growing 159% over that same period. I mean, that points to a business model that is fundamentally healthy, and that right there is the cornerstone of the whole bull argument.
So, what about that valuation problem the bears are so worried about? Well, the bulls say this pullback actually solved it. The forward PE, which looks at future earnings, is now down around 49. That is way, way below its 3-year average of 86. So from their point of view, the stock isn't expensive anymore. It's actually gotten a lot more attractive.
And when it comes to the scary-looking chart, the bulls have a simple counterargument. Zoom out. Seriously, when you stop looking at the day-to-day chaos and look at the weekly chart, this so-called breakdown is really just the stock coming down to touch the bottom trend line of a powerful, multi-year uptrend. They've seen it bounce hard from this line before, and they're betting it's about to do it again.
So this is the key takeaway, right? Both sides are looking at the exact same violent price drop and seeing two completely different things. The bears see a trapdoor opening, the start of a new downtrend. The bulls, they see a healthy pullback and a golden opportunity to buy a fantastic long-term company on sale.
Now, this battle between the bulls and bears isn't happening in a vacuum. To really get what's going on, we need to zoom out a bit and look at the bigger economic picture in MELI's most important markets, especially Brazil.
And the environment is definitely tricky right now. Economic growth in Latin America is slowing down. In Brazil, their key interest rate, the Selic rate, is at a sky-high 15%. That makes it really expensive to borrow money, which directly hurts Mercado Libre's credit business. Now, there is a silver lining. Inflation is starting to cool off, but currency risk is always a factor.
So what this all boils down to is a tough neighborhood for the company to operate in right now. The slow growth and high rates definitely help the bear case in the short term, but the hope for rate cuts down the line, maybe in 2026, is what's fueling the bulls' long-term optimism. So the macro story really cuts both ways here.
Okay, so with all of this context, where does the rubber actually meet the road? Well, it all comes down to a few critical price levels on the chart. These are the lines in the sand, the key zones that are going to decide who wins this war.
Let's map out the battlefield. For the bulls, they absolutely have to defend the support zone between roughly 1900 and 2050. If the price breaks and stays below 1950, it's game over. The bears are in complete control. For the bulls to win this thing, they need to push the price all the way back up and over that resistance wall around 2250. That would completely invalidate the whole breakdown idea. These are the numbers you got to watch.
And here you have it, the entire debate, the entire conflict, all in one slide. On the left, you've got that violent short-term breakdown that has the bears totally convinced the game has changed. And on the right, you've got that beautiful long-term uptrend that gives the bulls all the confidence in the world that this is just another bump in the road. It's two different realities happening at the exact same time.
So at the end of the day, the question is simple. Which reality is going to win? Is the short-term bearish breakdown going to drag the whole trend down with it? Or will that long-term support hold and the bigger uptrend take over again? The battle lines could not be clearer. The next few moves are going to be absolutely decisive.